Hey, good afternoon and welcome. I am Matt Price here along with Matty Kearns. We are the Price Group along with Randy Price, and we are talking about creating income for retirement. Something that may sound like a real buzzkill, but very, very important from a standpoint. Most all of our clients are retired or approaching retirement. Retirement is all we do. And this is a big part of the retirement process. How do we create income in retirement? So a little bit about us. We are family owned and operated, 50 plus years of experience. We follow a fiduciary standard. As I said, over 80% of our clients are retired, so have a niche in retirement. We think that is very important for families to consider from a standpoint. There's a lot of generalists out there, people who help people in families in their 30s, their 40s, their 50s. Retirement is all we do. And it's a real salient difference when you are producing income to take it out of a portfolio compared to when you're trying to just grow a portfolio during your working career.
I get to brag a little bit about Matt and Randy, tell you a little bit more about our team. Matt and Randy have been recognized by Barron's and Forbes, a bunch of other publications. Matt just named again to the Next Gen Wealth Advisors list by Forbes. We also, you can see the education column there. We believe education is extremely important in our industry, and all three of us, all the advisors on our team, hold our CFP, Certified Financial Planner designation, and Matt and Randy also have their CIMA, Certified Investment Management Analyst designation. A little bit more about our firm. Clients sometimes ask, who is the Price Group? What is Steward Partners? Where does Raymond James fit in? The Price Group, Randy, Matt, myself, our team, we're essentially the Houston office of Steward Partners, our firm based on the biblical definition of stewardship. 30 plus billion of assets as of the end of last year. Raymond James, they're a vendor of ours, our primary custodian, where client assets are held. And they've been a great partner of ours for the past 6.5 years or so.
So here's what we're going to talk about today. We're going to warm up our brain. We're going to look at a quick overview of the markets. What are the top 5 risks of retirement? We're going to go over that. We're going to talk about how producing income can mitigate these risks. And then a quick, brief overview of our approach to what we think is living well in retirement. So, but before we get going, there's dozens, maybe hundreds of reasons you chose to attend this. And it all kind of boils down to what we think are the 3 C's: clarity, comfort, and confidence. That's what everyone is looking for in their retirement. And usually people, when they log into a webinar, come to one of our live events, they're kicking the tires. They're saying, hey, I don't have these. How do I obtain them? Clarity, comfort, and confidence. And we'll talk a little bit more about that with how our process works. So warming up our brain here. What is the annualized return in the 1930s? Is it A, 0%, -3%, -7%, or 2% per year? And drum roll, please, 0%. So known as the lost decade of stocks, more recently 2000 to 2010 also was coined the lost decade of stocks. So the last 10 years for the stock market has been positive, absent 2022 being a negative year. It's been a good decade to be a stock owner, but this is just a reminder that stocks can have a prolonged period of time of moving down or just moving sideways, as we see here. So a little review of the markets. Our friend Mr. Yogi, he had a saying, it's tough to make predictions, especially about the future. And so we are not in the prediction business. We don't think that we are good at making predictions. As we look at the next slide, we actually don't think really anyone else is good at making predictions either. What we're looking at here is just the history of a bull market. You can see as we measure a bull market here, anywhere from 4 to 5 years is the quote unquote average bull market. The average bear market is just shy of a year. And stocks go up, stocks go down. They tend to go up over time. So we think stocks will continue to be a good place for some piece of your investment portfolio to guard against inflation as prices will continue to move higher. We think we're in the second, third, fourth inning of this bull market. And the title we used here, safe bonds, safe in italics. Each one of these, think of them as doors, represents a period of time. And we've chopped it up to show you how bonds have done well in certain periods. Bonds have not done well in other periods. And so history does not repeat itself. It often rhymes. What is something similar from the 1960s to the 1980s of what we've experienced over the last few years for the bond market has been interest rates started at a much lower threshold. I'll bring you back to your childhood playground. Interest rates and bond prices, they work like a seesaw. Interest rates up, bond prices down, vice versa. And so we think bonds are a real important piece of the portfolio. Here now currently, compared to this time last year, interest rates are higher, so that's good from a starting perspective on the income you can produce. But people think of bonds as really safe, and that's not always true. We think now you actually need a investment process for your fixed income equally, if not more than, for your stocks. That it can include CDs, that can include money market, that can include traditional bonds, that can include some private credit fixed income strategies, alternative investments. So there's a number of different ways to look at this. It's different for every family, but the bottom line is we think you need a process for your bonds and fixed income.
Moving on to the top 5 risks of retirement. What are they? Number 1, we've got longevity. In this case, the risk of outliving the amount of money you have saved for retirement. You can see here in the table, for a 65-year-old in good health, a male has about a 21% chance of making it to age 90, a female 33% chance, but a couple, there's a 47% chance that one of you will live to age 90 or beyond. So obviously your money needs to last and maybe longer than the technical life expectancy. You probably heard the figures high 70s and low 80s for men and women respectively are the technical life expectancy. But that includes teens, young adults. The phrase, the longer you live, the longer you're expected to live, that we found holds true, and it's something we really need to account for when planning for retirement. Retirement risk number 2, inflation. We call it a hidden tax in retirement. I think it's less hidden than maybe it has been before, given the past couple of years that we've all gone through. We've all felt it. But we think this illustration is pretty powerful. The rule of 72, what this is showing is you take 72 and you divide it by your rate of inflation, and the result is the number of years it takes for your cost of living to double. So take 3%. 72 divided by 3 is 24. At a 3% inflation rate, your cost of living doubles every 24 years. What about 5%? Just under 15 years. So obviously, inflation can take a big bite out of your retirement portfolio, and we need to account for it in the retirement plan. But we do that with a strategy that we're going to talk about in a little bit. The title of the presentation is Creating Income for Retirement, and that really is the main way that we see to combat the risk of inflation. And we'll get into that a little bit more here.
So here's the third risk. We think of retirement, which is market performance, also known as sequence of returns. So this is a little bit of a busy page, maybe less intuitive than the first two that we discussed. I want to draw your attention to the 2 boxes on the left, the top left box and the bottom left box. Those represent the investor during the accumulation phase, or while you're still working. What you can see here is with both examples, on the left-hand side, we start with $100,000. The top left box, you get a negative return in year 1, 7% rates of return between years 2 and 9, and a good 29% rate of return in the 10th year. You can see you end with $188,000 in change. Now, what if we get the same returns and just put them in the reverse order? Get that good return in year 1, the bad return in year 10, and the same returns in years 2 through 9. You can see we come out with the same output, $188,000 in change. So the point is, when you're still working, the order in which you get your returns, it doesn't matter. Now, that's a stark contrast to the 2 boxes on the right. The 2 boxes on the right represent retirement or the distribution phase. So in the top right-hand box, same assumptions, starting with $100,000, you get a bad return in year 1, down 15%, and you see you run out of money somewhere between years 9 and 10. However, if you have a good return, now looking at the bottom right-hand box, in the first year, at the end of the 10th year, you still have over $50,000 left in this example. So the bottom line is the sequence of return, it's really, 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 did I say really important in retirement? And that's something that we need to factor for as we plan for and walk through the complexities of retirement. So a little bit more on this market performance. How much does it take to just get back to what we call break even? Intuition might lead us to believe if the market's down 20%, well, we just need 20% to get back to break even. That's not necessarily true, and it's actually exaggerated in retirement when you're taking money out of a portfolio. So your portfolio in retirement, let's assume you're withdrawing 4% and your portfolio is down 20%. You actually need 36% just to get back to break even. Something we talk about with clients is we win by not losing. Or maybe said another way, the best type of offense is actually defense. And what we mean by that is we want to protect capital in a falling market. It's much easier for a portfolio in retirement to recover from being down, call it 8% than 20%. There's just not, the hurdle rate is much lower to get back to that break even. So the fourth risk in retirement, investing without a process. This is a little bit of another busy slide, but the red boxes there represent the biggest periods of outflows, or when retail investors were selling mutual funds and ETFs. And you can see there below, the dark gray or black line represents the S&P 500. Historically, retail investors end up selling at the quote-unquote wrong time. They sold at the end of 2002 when the market bottomed. You can see they sold beginning 2009 when the market bottomed. And then there was a big outflow during the pullback during COVID in 2020 as well. So having a process is very important. Knowing what you own, why you own it, having some type of behavioral discipline so you won't sell at the wrong time, we think is paramount to a successful retirement.
Retirement risk number 5, healthcare. You could make the case that the healthcare figure you see there, $315,000, is only going to increase. A 2023 study said the average couple is going to spend $315,000 in healthcare and medical expenses throughout their retirement. This number really sneaks up on a lot of clients. We wrote a blog post recently. Healthcare is one of the most underestimated expenses in retirement, truly a risk in retirement. You can see here the miscalculation. Almost half of respondents to a survey thought they would need less than $100,000 for healthcare in retirement. Wrong almost by a factor of 3. So something we need to be thinking about and preparing for when we're talking to clients and as we're preparing for retirement. And so it's important not only to have income and to be producing income in retirement, but more importantly, increasing income to offset this risk. So how, now that we've outlined the questions and the risks, how do we face these uncertainties? Step 1, create a retirement roadmap. We call this our Live Well plan. A lot of people view retirement just as a one-time event. My last day is December 31st, 2024. I need to make sure I take care of everything before that date. That's not necessarily wrong. You do need to plan for that date, but it's not entirely right either. Retirement is an ongoing process, something that needs to be managed more closely in retirement than it may have been managed during your working career. We also think if the plan is not written down, it's not a meaningful plan. A lot of things can be missed. A written down plan will help answer a bunch of questions. How much can I spend in retirement? How long will my money last? What rate of return do you need in retirement? We'll touch on that here in a few slides. And how much income do I need to produce? Again, a retirement roadmap, financial plan, we call it our Live Well plan, helps answer these questions. We call it the Live Well plan. We know it's cheesy, but it truly is our aim when preparing financial plans for clients. We want them to live well. So that's step one, retirement roadmap.
And it fits, I think it fits Randy, Matty, you and me. I think just deep down, we're just kind of cheesy.
You're pretty cheesy,
Yeah.
Randy especially. Step two, stress test your portfolio, part of the Live Well plan process. We look at how both you emotionally and how your portfolio could withstand another downturn in the markets. What if another 08 happens? What if another COVID black swan event arises? We discuss how you've handled that historically in the past. How did your current portfolio do in those historical down years? And then we come back with some recommendations on how you might be better allocated moving forward to reduce or mitigate some of the risk in your current portfolio. Sometimes clients are right where they need to be, but typically we do have necessary adjustments, typically reduce some risk, produce more income. Less quantitatively, emotionally, people have different emotional tolerances to volatility before retirement and after retirement. And that's another key consideration we want to talk through as you get closer to your retirement date. Third step, maximize Social Security benefits. Obviously, for most folks, Social Security is going to be a key component to the retirement income picture, maybe the biggest. And unfortunately, it's not always as straightforward as we'd like it to be. There are over 80 ways for a married couple to file and receive benefits with Social Security. Does Mr. Smith start as soon as he's eligible while Mrs. Smith delays until she's 70, or vice versa, or some different combination of other options? We like to joke and say, tell us how long you're going to live, and we'll tell you exactly when to take Social Security. Obviously, we don't know that answer, but you know your family history, you know your health history. That combined with some statistical analysis, you can see a screenshot there on the screen. All that combined helps us analyze your situation, your portfolio, and to make sure that the strategy, the decision you're making to take Social Security benefits at a particular date fits well in your Live Well plan. So it's a big decision. We know that. Clients are rightfully nervous when making the decision, but we can help you look before you leap as it relates to Social Security.
So our fourth idea is to promote income tax efficiencies. And what we're looking at here, these are just a few ideas. This is not by any stretch a comprehensive list. We had just specifically, for the sake of time, pulled out a few of our gifting strategies that we'll employ occasionally for clients. Qualified charitable distributions. Once you actually reach the age 70 and a half, you can give money directly to a charity to your IRA. The law currently reads at 73. That's when the required minimum distributions start. This qualified charitable distribution can offset the RMDs once those do start. A gifting of appreciated stock. This is something we do quite frequently for clients. Let's say you own Apple stock. You bought it for $10 a share. It's worth $30 a share, to make the numbers up. You can gift that stock at $30 a share, get an itemized deduction, and then use some cash just to repurchase that stock and reset the new cost basis at $30 a share. Once again, I made a stock price there, just to illustrate a point. The bunching of deductions, that's historically been something that we've talked about more, but given the fact that the standard deduction has moved so much higher, we don't see that as much as a strategy, but talk to your CPA. We're happy to explore it as well. We don't see that one used as much as we have in the past. Is 3% the new 4%? Step number 5, some cash flow planning. We will sometimes have people who are approaching retirement say something along the lines of, Matt, Matty, Randy, well, why can't I just take out 5%? It's only 1% more than 4. And while that is a very true statement on a percentage basis, it's actually a pretty big deal. What we're looking at on this slide is the differences between a 4, 5, 6, 7, and 8% withdrawal rate. And you can see over time, there's a real material difference of taking out 4% and 5%. Now, this study was done looking backwards over the 70s, 80s, 90s, early 2000s when interest rates were much higher. One could make a fairly compelling argument to say 4% is actually theoretically too high, just based off the fact that interest rates are now lower. Your portfolio is producing less income than it was during when this whole Trinity University is who put it out. This one was done by BlackRock, but Trinity was one of the first ones when they started publishing this a couple of decades ago. So we think it's every family's different. It depends if you're retiring at 58 or 75, but we think that is a big piece of how much do you take out from your retirement portfolio year over year. Step number 6, income-oriented investment process. In retirement, we think dividends should be your best friend. Most clients don't have all of their money in a dividend stock strategy, but they do have a piece of it in a dividend stock strategy. What we're looking at here is the dividend contribution to the total return. So the appreciation plus the dividends by decade. And you can see some decades are higher than others, but when we look at it over time, it's just right around 40% of the total return on average does come from dividends. So 40%, not a rounding error. We think that's a real material number and something that we pay a whole lot of attention to for clients. Now, what kind of dividend stocks should you consider? Should we look for the dividend stocks that just pay the highest dividends? That's a question we get a lot. Our answer to that is no. We're actually looking for companies that historically have increased their dividends year over year, opposed to the highest dividend payers. And the historical data we think speaks for itself. Dividend growers have not only outperformed the stock market, they've outperformed the dividend payers. And so we're big believers that if a company can continue to increase their dividends year over year, that means they have more free cash flow, which means they have more earnings, which typically means a higher stock price over a longer period of time. So we have a couple of different dividend stock strategies, but all of them are under this umbrella of we want companies that not only pay dividends, but historically have increased dividends looking backwards.
Step 7, plan for long-term care. A lot of clients ask us about long-term care, and as we saw on the healthcare slide earlier, oftentimes folks are underestimating the cost of healthcare. So we want to think through what that cost is going to be and what strategies we can put in place to help cover that cost. Some folks who have enough assets to call what we call it self-insuring. They have enough assets to cover what you can see here is on average 3.5-year care event in a nursing home room at $116,000 per year. Others could benefit by transferring that risk to the insurance company, getting a long-term care policy to help mitigate the risk. Could be right for some, maybe not so much for others. Also, we see clients that kind of earmark their personal residence, traditionally an inflation-resistant asset. They use that hypothetically as a pool of money future that could be used for long-term care. So a lot of different ways to solve it. Obviously, something we need to keep in mind and We can help you talk through pros and cons of long-term care insurance. The policies now are less attractive or lucrative than they used to be, but still could be a good option depending on your circumstances. And then step 8, consider hiring an advisor. We've talked about the impact of emotions during the investment process. It's been proven that making investment decisions based on emotions can have negative impacts on your returns. So we believe having an advisor come alongside you can be very helpful in this regard, especially as you approach retirement. As you're getting close to retirement, hopefully account sizes are getting larger and mistakes become more costly. Decisions are much more stressful. Do I invest in this or that? And so an advisor can help reduce stress, potentially provide more investment options. And also, there are studies here that show the average investor has underperformed the market as a whole. Randy likes to tell the story about a mutual fund manager years ago, very successful. He was asked what his biggest regret was during his tenure managing that successful fund. And it wasn't that he should have bought stock XYZ or ABC or sold it, then, or instead, it was that he regretted that the average return for the average investor was less than the return for the fund itself, because people were selling and buying, presumably at the wrong times based on emotion, instead of in the context of a long-term financial plan.
So good. Thank you, Matty. So let's look real quickly here at our retirement planning process. What does that look like? We think you need more than just an investment guide. There's a lot of people here in Houston who are good at helping with stocks, bonds, mutual funds. We have a good bona fide track record to solidify what we think are our strengths in doing that as well. But we think the real value add for a family is the holistic financial planning, the retirement, the investments, the insurance, the cash flow, the estate planning, the tax planning. Benjamin Graham, who was one of Warren Buffett's mentors, we think he said it best. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you to where you want to go. So we think that is key. That's what we sign up for. All clients do get this holistic financial planning, not just helping with the investment piece of the portfolio. And we also want to develop a family index number. Matty briefly mentioned this earlier. What rate of return do we need to be successful in retirement? And we want to do that with the least amount of risk, because like we said, we think we can win by not losing, or the best type of offense can be defense. And so coming up with that, what we do is we actually benchmark a client's progress, not against some index like the S&P 500, but against their family index number. And that's the rate of return we're using within the context of our Live Well plan to see if clients are meeting their goals. Are they ahead of track? Are they behind track? Or are they right on track? And so that's part of the Live Well plan. We said it earlier, the 3 C's, clarity, comfort, and confidence. That is our goal for each family. And we get it a lot. Clients go through this exercise and they come back with this kind of this sigh of relief of, okay, for the first time, I feel like I have comfort, or the first time I feel like there's a little more clarity surrounding our situation. So retirement, if you do it right, you only do it once. From where we sit, there's a well-worn path in front of you. And what I mean by that is we've helped hundreds and hundreds of families walk through and plan for the complexities of retirement. So it's not our first rodeo. We understand it can be daunting. We know you have options out there, but we would be welcome to create a Live Well plan, or I see a few familiar names on here. I know we've created a Live Well plan in the past, happy to dust it off at any point in the future. And for some other families, maybe you're not ready to reach out. Here's something helpful. What we think is, as you're kicking the tires with different people in our industry, I won't go through each one of these, but is the advisor a fiduciary? Do they represent you or the bank? There's a big salient difference between the two. Do they have a transparent cost structure? Do they have the credentials that we think are necessary to be bona fide retirement experts? You know, do they have a niche? What we find is a lot of people actually are just generalists. We're a specialist. We only really look at retirement. Like I said, 83% of our clients are retired. Our industry is moving more towards just a cookie cutter type of environment. You just get thrown into a growth portfolio or a conservative portfolio or a moderate. We think personalization matters now more than ever. And so we don't have a cookie cutter approach. We do that by having a low client to advisor ratio. That's a good question to ask other advisors you're talking to. And how do they communicate? Do you hear from them on a regular and consistent basis? Do you have to call them once a year just to see how you're doing? We work really hard at communicating with not only prospective clients, but more so current clients on trying to anticipate their questions actually before they ask them. So those were our prepared remarks. The trains are pretty close to running right on time. Want to thank you for attending. I'm Matt Price, Matty Kearns, Randy, and then the rest of our team as well pictured there. If you have any questions, we are happy to answer them by email, phone, set up a meeting, whatever works best for you. And we are here if you need us. So once again, thanks for coming, and reach out if you need anything. Take care.